we've just loaded up the charts for big tech, and you've seen a lot of pressure well off of their 52-week highs. On Friday, you saw losses across the board for the Mag 7. I mean, you're hard-pressed to find a gainer in the S&P 500 on Friday. What are you paying attention to when it comes to big tech, KG?
Yeah, I think big tech is going to be trading on the risk of retaliatory tariffs or actions coming from the EU. The EU has made maybe some comments over the weekend around potentially hitting a lot of these technology companies. And that's something that's going to hit their top line as well as their bottom line here. And a lot of these companies have a significant amount of exposure overseas just in general. I think also when you're kind of looking at NVIDIA, I think it had dropped down to around $88, even actually $83 or $84 overnight. But NVIDIA does have exposure to China. Around 22% of the total sales, when you're looking at top line revenue, can be sourced back to China in one way, shape, or form. So I think that's where you're going to see a little bit, maybe some hesitancy when it comes to institutional dollars being put to work. But one area or a couple of areas that have been something to keep on the radar here, high dividend yield stocks have been something that a lot of institutional traders will get into in times like this. So be mindful of that. And then also mid-cap stocks or small-cap industrial stocks, those that do not have a lot of international exposure, could also be ones that maybe outperform. Doesn't mean that they're going to be in the green, but maybe outperform the benchmark index like an S&P 500.
Following President Donald Trump's declaration on April 2nd of reciprocal tariffs of at least 10% for numerous nations, the U.S. economy and international markets are once again undergoing turmoil. In the 2 days after the tariff announcement, the tech-heavy NASDAQ composite fell 11%, while the S&P 500 index fell 10%. Because imported goods may become more expensive, the high tariffs may have a significant impact on American businesses and consumers. On April 3rd, Ashish Shah, the chief investment officer of public investing at Goldman Sachs, stated, "We see this as a sort of growth shock. This is going to be a hit to U.S. consumers." Even though the White House claimed that tariffs do not apply to semiconductors, the disruption can nevertheless affect demand for semiconductors and have an effect on downstream electronics manufacturing. The Philadelphia Semiconductor Index fell by almost 10% on April 3, 2025, more than the S&P 500 index, which fell by 5%. On April 4th, it dropped 7.6% further. NVIDIA, which is frequently seen as a predictor of the need for AI-driven chips, has not been exempt. Over the course of the 2 sessions, the stock fell more than 14%. Following the recent tariffs, HSBC analysts downgraded NVIDIA's stock, pointing to growing supply chain inconsistencies and future limitations in GPU pricing power. Other Wall Street firms also voiced their opinions. Additionally, Bank of America revised their prediction for NVIDIA stock. NVIDIA was facing challenges even prior to the tariff announcement. Long a Wall Street favorite due to its dominance in AI, the chipmaker witnessed a roughly 20% decline in its stock price in Q1 2025 as a result of the introduction of China's low-cost AI model, DeepSeek, poor results, and a wider tech sell-off brought on by economic uncertainty. In the fourth quarter of 2024, NVIDIA's revenue growth, which had previously been flying at triple-digit rates, dropped to 78% year-over-year. This was still good, but it was a letdown for investors who had been expecting more. Meanwhile, meeting the demand for Blackwell has begun to put strain on NVIDIA's profit margins, even if CEO Jensen Huang has often stated that the demand is extraordinary. So what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
One question I have is you have people revising their forecasts lower for the S&P 500. You pointed out the uncertainty around earnings, but you also have economists now bringing down their forecasts. You have Goldman, for example, rising their recession probability to 45% and growth down to 0.5%. But this assumes, David, that the April 9th tariffs don't take effect in their entirety. Why are so many strategists, economists, investors not taking the president at face value anymore, despite how much we've seen an escalation?
Well, I'm not so sure that I saw that out of the various Wall Street economists that you've discussed. I think that they did factor in the tariff staying in place. What they didn't factor in is what sort of further retaliatory measures are going to take place, because what we're finding out about China is that they're not going to back down, and they hit back with a 34% equivalent levy on U.S. goods on Friday. So the problem is that you can try and do your best estimating what's already happened. I haven't seen anybody saying, well, we're not assuming what happened in the Rose Garden last week is not going to be in our forecast. I think that's in the forecast. What's not in the forecast is what happened in the 1930s, which was not just the initial shock from Smoot-Hawley, but the fact other countries retaliated, and we tripped into a global trade war. And that has all sorts of other monumental second-round impacts right back on the economy. So I think that's really right now what the big question marks are. We've seen China hit back. We haven't seen what the EU is going to do. And the EU can hit back big time, especially on services. And so those are really the big unknowns right now. The big to me, the big unknowns aren't, oh, well, these countries are going to sit down with the White House and start negotiating. Negotiating what? Everybody thought we had the negotiations heading into last week's reciprocal tariff. So what are we going to negotiate, basically? That's not the issue. The issue is really how are other countries going to hit back, and we haven't seen that full brunt just yet.
David, I want to point to your note this morning where you title it, "Is the market oversold?" You say yes. Is the bottom in? Likely not. So where's the bottom? How do you figure out how low, how bad things could get from here?
Well, I spent the weekend fielding questions from clients about picking the bottom, to which my reply was, I'll leave the bottom picking to the proctologists because I think they do it better than the rest of us. The sentiment is clearly washed out. And, when the VIX breaks above 40, and we went back in the history books, and if you have a 12-month view, the market's up 96% of the time historically 12 months later. So the message was that we have a nice opportunity here. If you're willing to adopt a 12-month view, everybody tells me I'm a long-term investor, I'm a long-term investor, I'm a long-term investor, yet everybody looks at their portfolio like every 20 minutes. So the question is, and I think the president maybe put it best when he said, we're going to have to put up with some near-term disturbance or pain for the cause of the greater good, whatever that's going to turn out to be. But I think that you do have a lot of measures washed out. I mean, where in some cases you got some critical sectors of the market, transports, consumer discretionary, the banks, all in bear market mode in the span of a week. Like what normally you take 6 months to do, we've done in this wild elevator ride just in the matter of the past few days.
Well,
what I'm saying is that
let me just jump in here and ask. Because yeah. I think so many people in this market aren't used to default being anything but rise, and we could get in a situation where even with a rally, you want to sell those because the market will continue to go down, 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 like 2000, 2001, 2002. Is that what you're expecting here?
No, I think that, trying to pick the bottom in this fog of uncertainty is next to impossible. What I am saying is that if you're going to ask me in a year's time, looking at the indicators that I have at my disposal, I think the market will be up a year from now. It's like we're talking in in January, February of 2009 when we were sinking into the abyss and the banks were getting priced for zero. I never want to touch equities again. And yet, the VIX provided a tremendous buying opportunity signal if you had a 12-month view. If you bought the stock market in January, you had to write out another 20% decline to the March 09 lows. But if you had a 12-month view, you made money. The question is, what is your tolerance for pain near term? Because nobody can actually pick the bottom. And are you willing to take on a 12-month view and be patient? So I think very suddenly you've had, a lot of appeal through the turbulence come into the market. But again, it depends on your time horizon. Do I think that we've hit bottom just yet? No. And I wouldn't tell anybody right now to jump into the market. But if you're underweight stocks and you didn't participate in the bubble and you're sitting with liquidity, you're getting a bit of an opportunity here. I would be tempted to sort of scale in gingerly. I would not jump in with both feet. And that's more of a message for people that have the liquidity and that didn't participate in the bubble and who weren't hurt by all this. There are people out there like me that weren't drinking the Kool-Aid at the highs. Right. Ergo, I got the liquidity and the cash in place to look at this and to start picking my spots. And let's face it, the market has cheapened up a lot. We basically, I mean, you got these economists saying, well, 35% recession, 45%. I don't even know how they come up with a percent recession. You've got sectors in the market right now. And like I would say that the credit market and the stock market have basically crossed the halfway point in pricing in a full-fledged recession. A lot of work's been done, maybe not enough, but then you got some sectors that are already in an official bear market.
Right.
And those are the ones that you might want to, start paying attention to and get your pencils and paper out, because I think we're building up. And if this continues in the next week, I'll tell you this much: if this continues in the next week, I'll probably turn very bullish on a 12-month view. Well, because the markets have a tendency to overshoot in both directions. We certainly did it at the highs, and we're going to do it at the lows. I'm not going to say we're there yet, but I think we're in a week's time or 2 weeks' time, we could be there. Great, given how fast things are moving.
For the fourth quarter, the company's non-GAAP gross margin was 73.5%, 3.2 points lower than it was a year earlier. Blackwell and other newer, more expensive and complex data center devices were blamed with the lower profit margin. The Asia-Pacific area is home to the majority of NVIDIA's supply chain. Taiwan's semiconductor manufacturing company and other foundries are crucial to its chip manufacturing. Huang has, however, stated that he didn't anticipate tariffs having a major effect on the company's prospects, and that NVIDIA will eventually move more of its production in-house. In the short term, tariffs will affect us somewhat, he said. Bank of America continues to be NVIDIA's steadfast supporter in spite of these obstacles. Following Trump's tariff announcement, analysts led by Vivek Arya listed NVIDIA as one of the company's top semiconductor options, along with Broadcom, Lam Research, and Cadence Design Systems. These businesses, according to the expert, have the best balance sheets, profit margins, and scalability. No business is impervious to the effects of tariffs, according to Arya, but those with strong balance sheets and significant exposure to AI, cloud, and complicated computing are probably going to fare better in the medium to long run. Major U.S. cloud providers like Microsoft and Meta, who can afford to pay more for mission-critical AI deployments, should continue to invest pretty well on AI, he suggested. Additionally, Bank of America pointed out that companies like Texas Instruments, Intel INTC, Global Foundries, and Wolfspeed that have manufacturing assets in the United States might profit from changing supply chains. Pricing powerful businesses like NVIDIA and ARM are also probably going to be more resilient in the face of economic upheaval. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
Man, you had a busy weekend. I was looking at some of your stuff over the weekend because we were all kind of working. Musk created a brand crisis, and Trump tariffs equals a perfect storm for Tesla. Apple, tariff uncertainty turns the supply chain upside down. And really the one I think that got perhaps the most attention, economic armageddon. You're not feeling too good about anything, are you?
Yeah, look, I mean, and we've talked for decades. I mean, I'm one to always look through near-term issues, structural, dot-com bubble, financial crisis, COVID date. The difference here is that for U.S. tech, it would be the ultimate, what I view as an Armageddon relative to the supply chain, and really take the core thesis that we believe U.S. tech is ahead of China, and that would really throw that out the window. And that's why we've written about it so much, because there's someone that spends so much time in Asia, so much time, in fact, in China, seeing how these things are actually produced. The reality of bringing it to the U.S., it's just, I view it as
Explain what's behind your belief, though, in terms of where is the cost then? We've been talking about a potential slowdown given CapEx numbers, which are already incredible, would have to go even higher. But explain to me what is the Armageddon based on?
Yeah, a lot of it is based on the supply chain is cemented in Asia. For example, if Apple brought it to the U.S., it would take $30 billion just to take 10% of that supply chain. And I believe iPhones, if they were built in the U.S., would be $3,000. If you look at the way the structure is of the supply chain between Taiwan and China, the concept that you can actually make fabs, we have the labor force, the manufacturing takes 4 to 5 years to build a plant. That's why it's Armageddon. And the reality is that once this snowball starts going downhill, data center demand, uncertainty, you've already created not just a recession, but it goes back to my whole career. For the first time, U.S. is ahead of China in tech. This would wipe that out, and China ultimately would zoom ahead. And that's why we've talked about it so dramatically.
Did you see the Dave Chappelle clip that was going around over the weekend? I mean, I feel like that actually really nailed it. It's like, we want to buy iPhones. We don't want to make iPhones in this country. And I do feel that there's a lot of folks around who are looking at the U.S. model. We're the envy of the world, right? Why do we want to become more like them?
And my thing is, it's a sad day for U.S. tech. And, talking to so many within the supply chain, whether it's Asian, U.S. tech companies, what they could say publicly or not, private companies, the reality is that the reason it's an Armageddon is that this would really wipe out, in my opinion, the modern U.S. tech world relative to the way that we produce chips, the way that we produce hardware, how data centers are built, and the concept that we're actually going to build this in New Jersey, in West Virginia. It could sound in front of a microphone. It's just not reality, and that's why I felt very compelled to speak out. And is it from a stock perspective, it's trying to figure out what the worst case, what could this mean for Apple? We didn't downgrade any of our stocks.
Why
in terms
not?
of rate.
Why didn't you downgrade
because,
it?
It's a great question. The reason is because if I believe this is permanent, then it's game, set, match. But if I believe that this is in some way temporary for a few months or some negotiated, we got to be able to look on the other side.
Coming back to the big question that everybody has and that we were having conversations with all the decision makers or many about this weekend, I'm sure you were having some of the same. Is it a negotiation or is it permanent? Well, is it designed to raise revenue simply and that's really what it's about, or is it really designed to lower barriers? I don't know.
And for right away, just for this, Street already 5 to 7% cut to numbers. If right now they announced the deal, you'd already cut numbers just based on the uncertainty.
What if they don't announce a deal? What happens to the earnings of Apple?
Well, first, I don't think any company gives guidance on the calls, but I think Apple, if they didn't, you could be looking at 10 to 15% cuts. If this continues for months, just given the cost structure, then you start to look for a lot of these. You could be looking at 20, 25% cuts across the board.
On earnings, on EPS.
On earnings and the EPS, just given the actual cost structure. And then it goes to, let's say, on software, where we're more bullish cybersecurity, the self-fulfilling prophecy, given uncertainty, data center, AI revolution, you could cut 15, 20% of that demand right now just based on the uncertainty. And that's why the sad thing, as someone that's such a supporter of U.S. tech for decades, is that what this has essentially done is cut U.S. tech at the knees. It would be like in a baseball game, me coming dugout before the game, like, okay, you're not going to have a catcher. You're not going to have a shortstop and no left fielder. Good luck. You should have a great game. But 3 years from now, I'll get you a catcher or a shortstop. That's the problem.
Right. The other thing in your note about Tesla is the political risk that Musk, you say, has introduced and is going to result in the loss of the future customer base. But that's been going on for a while. So what was it that changed your view on that front?
I think it's because our view, and we've talked about it, step back, balance it. Doge being CEO of Tesla, he continues to go forward and forward. And my view is that 20% demand destruction in Europe, 10%, I'm talking permanent destruction in the U.S. As one of the biggest supporters of Tesla, it's basically you're yelling and basically telling whether it's Musk and the board, this is the time. Because if you don't do it now, then ultimately you risk permanent brand destruction that I believe changes the Tesla story.
Over the past 2 years, investors have poured money into technology firms, hoping that artificial intelligence, AI, could be the next big thing. In addition to driving the Dow Jones Industrial Average and the S&P 500 higher, it should come as no surprise that tech stocks led gains in the NASDAQ composite. Last year, NVIDIA and Palantir Technologies had the best results in those two indexes, respectively. However, Wedbush analyst Dan Ives has been quick to point out that the outlook for tech equities isn't looking as great today. Ives referred to President Trump's announcement of his comprehensive import tax plan last week as an economic armageddon that may be difficult for American IT companies. Trump established many more tax levels that are applicable to particular nations and imposed a general 10% tax on all imports into the United States, with the exception of those covered by a North American trade agreement. The issue is that import taxes will increase the costs of tech companies who often manufacture their goods outside the United States. In light of Ives's remarks and this new challenge, is it wise to purchase tech stocks at this time? Let's examine it more closely. As previously stated, Trump's tariffs differ by nation, with high amounts in important nations where IT companies produce a large portion of their goods. For instance, Taiwan's semiconductor manufacturing is where NVIDIA makes its AI processors in Taiwan. NVIDIA will be liable for the 32% levy that Trump has placed on goods originating from that nation. As an additional illustration, Apple produces its well-known iPhone and other goods in China, India, and Vietnam, among other nations. Trump has imposed 54%, 27%, and 46% tariffs, respectively, on imports from those nations. These rates will apply to Apple as it imports goods into the United States. Last week, Ives wrote on X that Trump's action will regress the U.S. IT industry by 10 years. This would be a lottery ticket for the China tech landscape, and the cost structure of the U.S. tech world would make it impossible to compete with China, Ives said. According to the theory, technology companies would have to raise the prices of their goods in order to compete with their non-U.S. counterparts, either because of the greater cost of production in the United States or because they would have to pay import taxes. Earnings would undoubtedly suffer from all of this, and as Ives points out, it would enable foreign firms like China to overtake American tech firms. These worries help to explain the recent sharp decline in tech stocks, which even sent the Nasdaq into a bear market after plunging more than 20% from its highest point. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
First of the trade is behind us for the moment. Good morning, Kevin Green.
Well, we hope so, right, Nicole? At the end of the day, we are seeing some aggressive selling to start today's session, but not as aggressive as we saw the overnight futures when they opened. Obviously, we saw a massive move to the downside here, getting towards that and actually hit that 5% overnight. What I'm kind of looking at for the longer-term time frame right now, we have three gaps on this chart that has developed here. And from a technical standpoint, you would make the assumption that at some point we should be at least trying to test these gaps. So I'm kind of looking at this downside move here. That 5,000 level is going to be a very key area for us. We're below it right now. The next area I'm kind of looking at is the 4,800 level. And if we do get a bounce back over the next couple of trading sessions, given how aggressive the market has been and how high volatility has been, to the upside, you're looking at around 5,400 if you're looking at the longer term time frame. Now on the intraday session here, 4,800 actually could be a key area here for the market to try to defend. The reason being is it kind of aligns with some key moving averages on the daily chart as well as the monthly chart. And then it also kind of washes out potentially a lot of this option structure that we're seeing at that 5,000 level. And that 5,000 level is going to be very key. There's a lot of positioning that is there. If you're just looking at the June expiration alone, that 5,000 level has around 569,000 contracts for the calls and puts combined here. And that structure is really kind of going out in time. So the market makers, dealers, those that watch options flow, that 5,000 level is going to be a critical area for us and may also stabilize us for volatility in the near term. To the upside, you're looking at 5,110 is your first area of resistance, and then 5,200 to the upside here. But once again, Nicole, 4,800's got to be that line in the sand. We got to be able to hold that here today in order for us to even try to have a glimmer of hope that some of these technicals on the longer term time frame are going to be able to hold up.
Yeah, I mean, as we see the 4,800 mark here, you know, everybody, we saw 5,800 last week. Well, we were close to it, I should say. We were at 57 something earlier in the week. People were surprised. You may remember we started higher in the beginning of last week, and people started to look to 5,800, and then we couldn't hold 57, 56, and here we are now below the 5,000 mark, and I think you're showing some key numbers to watch. That being said, in the long-term trend, you mentioned the 4,800 mark. What else are you looking here for? Because the downside is evident. I'm looking and I see pretty much every sector in the red, and it looks like some of the same names are in the green. The Nike, the DR Horton, the same ones that held on Friday. So the long-term bottoming trends, anything else you can add there?
Well, if you're kind of looking at the monthly chart, we've been kind of highlighting this 46.52 level. That's the 50-month simple moving average on the monthly chart. That is going to be a key area of support, Nicole. If you kind of go back and look at previous corrections or bear markets, that 50-period moving average on the monthly has been a key area of support. Now, that doesn't mean that we can't flush through it throughout the month, but you would hope that maybe some buyers will step in. We only have one time where there was a complete flush of that 50-period moving average or that 50-month moving average. And that is really looking at the 08-09 crisis that is out there. So we're relatively close, only about 200 points, give or take, to the downside for the S&P 500. But I would maybe some buyers actually try to step in here. RSI getting to that 41.24 level on the monthly chart is also going to be another key area that we do see bounces for in the market. So can we have more downside? Definitely. But we are testing a key area when it comes to the trend line off the October 2022 lows, as well as that 50-period moving average, which we might be testing that, today, tomorrow, over the next week or so. That kind of gives you, I don't want to say confidence, but maybe some of this washout is going to be done for now. And if we're kind of talking about the risk, because obviously we have the tariff risk, the biggest risk, Nicole, for this to be prolonged is going to be credit. And that's where that 08-09 scenario kind of comes in at. We haven't seen any type of credit blowups yet, but you're starting to see credit default swaps starting to move to the upside in price and in premium, which is not really a good sign here. High yield investment grade bonds are also moving to the upside when you're looking at that yield. So if we actually do not get a resolution over the next week or 2 weeks, we can start seeing liquidity markets starting to dry up, and then credit availability will hit the market when it comes to shipping, logistics companies, consumers like yourself and myself, and that's where this becomes a little bit more prolonged. So hopefully we find a resolution fairly quickly before this creates a credit event that may need additional or corrective actions from either the White House or from the Fed. And I just want to capstone this real quick. The meeting today from the Fed is a normal routine meeting. They meet like this every single month. So this is not an emergency meeting, and I want to be able to make sure that we set the record straight there. It's not an emergency meeting. We probably won't get any fireworks or bombshells that come out of this meeting. This is a traditional routine monthly meeting that they come together on. That's usually close to.
Great point on that as well. In the meantime, you have Jamie Dimon, Bill Ackman, Stan Druckenmiller all speaking out, sort of voicing their concerns about the tariffs, how they're being done. At the same time, President Trump saying and noting just moments ago how many countries are speaking with us now, with the United States. Japan is sending a negotiating team. So it's underway, and this is the medicine. The VIX overnight, I believe, was at 60. Now it's around 51 or so. So it shows fear in the market is not its highest point. What are you watching when it comes to the VIX?
Yeah, for the volatility index, if you kind of go back all the way to 1986 here, it's the fourth highest that we've seen in a type of cycle. And the VIX can stay elevated for a relatively long time here, but this is an outsized move. You're talking about a 7 standard deviation move, very small fractional move when you're kind of looking at the overall trend for volatility here. This is where you kind of maybe get a little bit close to that capitulation moment where everybody tries to sell everything. And that could actually be a decent buying opportunity for long-term investors. In the near term, if you're a day trader, if you're a swing trader, this is a very hard market because of the volatility so elevated, and also options are priced really high. But once again, this is kind of a generational type of an event here. And what you would like to see is volatility subsiding, and usually 80% of the time, that's going to correlate with equity markets trying to move higher. We can have counter trend rallies within bear markets as well. You have to be mindful of that. But if you're kind of just looking at these extremes, Nicole, it just kind of, it says, yes, we have an event. Once again, you don't want the credit side of this because that's where you get volatility to really, to blow out here. But if you're a longer term investor, 10, 20, 30 years, you go back in time, sometimes these provide actually decent opportunities for those that might be looking for value in the market. And I don't think you'll probably get the market to really back out of volatility until you get an announcement about either Japan, China, or the EU. Some of these other smaller countries, that's fine, right? But I think the market is really focusing on those big 3 trading partners.